Hello, everyone. Good morning, good afternoon, very good afternoon. How is everyone doing? All doing okay? Life is good? Hello, Steve. Hello, Ramesh.
Hello, Vivek.
Good, good. We got a lot of stuff to cover. I just 5 minutes earlier, I updated the image on the meetup invite to confirm that instead of reviewing one company, we're going to review 2 companies today. So today most of our discussion will be focused on reviewing the S1 document of a couple of companies that are about to IPO pretty soon. I don't know the exact date, but I think it could be maybe next week. So we're going to review 2 companies and form our investment thesis on that. So I'll bring forth some points, and then we all together can review and understand, if it is worth investing or not. You can make your own decision based on the information that we discuss in today's meeting. And of course, we'll talk about a little bit about market, not too much about markets today, unless you want me to dig deeper. And of course, we'll review some of the option trades. So that's the overall agenda for today. I was planning to review only one company, but then I realized a few people had asked me about another one, so which I added. So I have a symbols up. Any guesses? What companies will we be reviewing today? I'm just trying to warm up, while we get a few more people joining the session. Any guesses on? Deliberately, I didn't put the names. Any guesses on what companies is on my agenda for review? Both are tech companies. Okay, I give that. But which tech companies is the biggest question. All right, so let's get started. Tesla. No, Sonia, the Tesla is already IPO. These are the pre-IPO companies. They released their S1. And I went through their S1 document, trying to understand what these companies do, what their financial position is. I run any, these companies, any pre-IPO company through my investing analysis structure. And that's what I'll be sharing today. Vimeo, no, it is not Vimeo. It is Vimeo is tech company, but not the one that I'm going to review today. Vimeo is already IPO. It's already trading in markets. So the one which we're going to talk about are the pre-IPO. Is it optionable? Of course, when a new company goes to IPO, they're not optionable immediately. But if there is enough interest in the company, exchanges will create, start adding options pretty soon. So from that perspective, I think those will become optionable, but of course not right now. Okay, Launchpad. No. By the way, this does give me some hint around what are the other companies that I should put on my radar for reviewing their S1s. So Launchpad. No, but these are not, it's not even Launchpad. Okay. All right, you guys can keep guessing. And so let's start with today's session. Okay, Liz got it right. One of the companies is Confluent. Which is the other one? Yeah, these companies are not household names. So even one company I never heard of before. Confluent I was aware of. The other one I haven't heard of. Okay, you can Google or do whatever you want to do to get to the answer, but let's start with today's session. So welcome everyone. This is our discussion number 83, where we talk about stocks, we talk about market, we talk about option trades, we talk about some pre-IPO companies as we're gonna do it today. And I appreciate you joining me and motivating me, and in some cases even forcing me to do my work, do my homework before I come here and talk about companies. So today agenda is primarily to review two companies who had filed their S1s and will be listed on exchanges pretty soon. I think it's 1 or 2 weeks. So want to go through those two companies, what I found in terms of their business, financials, management, technology. So we'll do a deep dive into the S1, and then we'll also look at, like we do in every session, pick up one option trade, look at how the previous option trades have been doing, and spend some time talking about markets. And of course, we'll be willing to answer any questions that you may have. Okay. All right, before we dive deeper, please understand anything that we talk here is for education and a little bit of entertainment, but it is not a financial advice or an investment advice. So don't go and trade based on solely what you see here. Okay. Apply your own judgment. Talk to people who are more intelligent. There is wealth of information available outside. I'm trying to do my part. Get some more feedback before you make your final decision. Okay. All right. So as always, I'll leave you with the question of the week. We'll proceed further. I'll come back to the answer later on. Think about this question. One company that you are most interested in buying at 25% or 30% below the current price. You know, the company is that if it throws away discount, 25% discount, you will be willing to buy. There could be more than one. Just making sure that we can talk through few companies and give chance to everyone to share what one company, the topmost, which you are willing to buy if that is available at 25% discount from the current market price. Think over it. Even though the markets, at least the Nasdaq hit all-time high, Friday markets did S&P and Dow Jones Index and Russell, they were lower, but many companies are already on all-time high, especially on the tech sectors. So you might be eyeing some companies, you might have thought, oh, we missed the boat. We talked about some companies last week in which we thought we missed the boat, but it has come back down, which is another company which is still is right now seems to be expensive from your perspective, but you will be willing to pick it up if it comes down 25%, if it is available at 25% discount. So I'll get back to this topic in another 5-10 minutes. Meanwhile, think through it and throw one answer. And also, I'm want to understand your reasoning behind what's your conviction behind this company. Okay. I'll start with mine. All right, quick look at the market sector. Last week, FOMC meeting was a big, I would say, event. So we heard from Jerome Powell on what transpired in the meeting. After a long time, Fed has finally, we saw Jerome Powell saying that now we can talking about increasing the rates, or Fed trying to taper their purchases. Fed also mentioned that they may start to increase the rates by 2023. Market thinks that it might happen sooner. and markets reacted. But I was really surprised in the way market reacted to that news, if I may call that as a news. Generally, increase in interest rates bode well for financials and not so good for growth companies. But the way market reacted on Friday was exactly opposite. Financials were down and tech was flying high. Go figure. Markets, have a tendency to surprise when we least expect. But anyway, I think at a overall perspective, the players in the market are now expecting that maybe we will start to see some tapering and increase of rates maybe by end of 2020 and early 2023. But at least Fed has now kind of accepted that the inflation is real. It's we just can't no longer hide the inflation. It is showing up in all the goods that we purchase, all in our day-to-day items. So we'll see how happens in long term. We still got almost 6 months to go in this year. So at least till year to date, markets have done pretty well. If you look at overall S&P index, till year to date, it is up, almost 12.5%, which is pretty good. And even though some of the sectors that were beaten this week, especially financials, material, energy, these are all reopening place. Industrial, energy, financials have been doing wonderful in 2021, got beaten in this week. But even after that beat, they're still up. Real estate up 23%. Energy is still the best sector, almost 40%. Financials up 22%, even though it got beaten this week by almost 3.5%. So 12 overall, if you look at it, S&P, it has got 12%. How much more room does it have to run? Depending on what analyst you follow on Wall Street, there are, I think it runs across a spectrum in terms of what the players are thinking. If you look at a fund strat, Tom Lee, he's always bullish. I see him as a perma bullish. Irrespective of what the situation is, he's always bullish. Be it stock market, be it crypto market. And Stan Druckenmiller said, I think we have already run whatever we could. 12.5% in 6 months is too good to be true. So again, I don't try to guess where the market would go. Beauty is that if we are trading options, we can trade on both sides of the market. So I'm not trying to guess or time the market on when to enter and when to exit. From my perspective, always stay invested. If you have capital available, which you don't need for next 3 years, outside of your emergency, outside of your big expenses, put it to use. We don't have, and if you're using options, we don't really have to pick a direction. Or even if we pick a direction and market goes against us, we could still make money. So we can give ourselves some room for error. If you're bullish, it's okay. Or if you're bearish, you can still do bearish trade. And if market goes high, we can still defend. So I'm not trying to add a lot of money or take money out of a market. From my perspective, I'm not changing anything from my investment thesis on market. Continue to stay engaged, continue to sell options and trade. David says, in the past, have you found it worth staying fully invested even in crashes like 2008. So David, I wasn't in United States in 2008, so I wasn't trading in this market. So I'll be very clear. I entered in this country in 2009. So I don't have an experience of trading here in 2008, but I did go through mini crash of 20, I wouldn't call it a crash, a mini recession of 2018 and then 2020. Of course, those were not really a long recessionary periods. But I was trading and invested in Indian market in 2008, and I didn't pull out anything. And glad that I didn't pull out, because after I moved to US, I stopped looking at that market. And after 4 or 5 years, all those positions really worked out well. And then I decided I'm not going to trade and focus on Indian market. So I kind of sold them and moved and started focusing only on US markets. But whatever I had, those positions did turn out to be okay. The 2009, perfect timing for the strongest and longest running bull market. Yeah, I came to US in 2009, didn't start to invest because I had no idea of how US market works. So my first surprise was when I started looking at markets, I looked at some IPO and I had opened my account at Scottrade. And when an IPO came, I logged into my account. I'm like, where do I invest? I didn't know that as a retail investor, I can't invest directly at IPO price. In India, I was able to do it. So I always thought US market, capital market is the most efficient and probably the most retail investor friendly. So that was my first surprise that I can't invest in Facebook. I wanted to pick on Facebook at its IPO price. And then I started digging deeper into how US market works and realized that it is not as retail investor friendly as I thought, or as I was accustomed to investing at IPO price, at the same price at which the institutional investors would come in. So those who are interested, the way at least it worked in Indian market is when I log into it, each of the companies will retain some portion for retail investors, the other one for institutional investors at their IPO price. So when I log into my trading platform, I will be able to commit how much money I want to put in or how many shares I want to buy at a different price points. And then if there is more demand for those shares, I will be allocated those shares on a pro rata basis. So I may not get all what I want, but I wasn't completely shut out of IPO market as a retail investor. But that was a surprise for me when I started looking at the US markets. So number two, I didn't start investing in 2009 because, again, I want to make sure I have money that I need for next 3 years. I don't want to put in the market. So I was in my initial phase of accumulation. If I had invested, probably would have done way better. But then it violates my principle of I don't know what's going to happen in market tomorrow. So I waited until I have my 3 years of extra money and then got into the market. But anyway, when I invested in market, that was still bull run has still continued even after that. But that was my surprise when I started looking at US market is I can't invest in IPO, and only those who have connections with the Wall Street, institutional investors, only those are allowed to invest. I'm like, that doesn't really sound great for the most liquid and the so-called best capital market in the world. But it is what it is. Hopefully now SoFi and Robinhood are trying to change it with their new offerings. Robinhood has got IPO access, if I got the name right. I don't know what SoFi has named their product, but through those, as a retail investor, we will have an opportunity to invest at an IPO price of many these high-flying companies. Sometimes TD Ameritrade does send me that we are participating in IPO of company XYZ, but those are the companies that I don't want to touch. All the good companies, all the companies that are everyone is interested in, we don't get to invest at an IPO price. Anyway, I'm done with my ranting about the whole surprise that I got. So here we have a comment from someone who actually survives 2008 crash. Ramesh says, yes, I've survived 2008, 11, and the recent one. Yeah, so I've done not 11. I think I started getting into 2012. Learn not to panic, keep cash to take advantage. After all, it is a paper loss. Yes, you may be in for a long haul. AMD, MS, FT, NVIDIA are all good examples. It paid off for me. So exactly, I completely agree. It depends on how, what's your outlook is. So there has never been at least in US market, there has never been a 20-year period where the stock market S&P 500 has returned negative. So if our outlook is that I'm doing this for my retirement for 20-year period, market has crashed, how do I bother? I don't need that money right now. But if I need something I need it from a house purchase next year, and I had invested it in 2007, I would be in trouble. So that is why from my perspective, I look at 3 year, minimum 3 year. The markets will go down, and I can't remember the exact statistics, but there are stats around every 3 year market will go down, I think 10-15% once or twice. Every 5 years, it goes down 15-20% once. Every 10 years, it goes down 30% once. But 20 years, there is no 20-year period where we have seen market actually going down. So look at your outlook. If you are investing in and you need that money in next 1 year, I would say don't even put that in stock market. I don't care how attractive a company might look like. If you need that money next 1 year, maybe that's your kid's college fund. Maybe that's a down payment for your house. However painful it might seem to just put it in a CD to earn 0.5%, I would actually do that. I will not put it in the market if I need it for next 1 year, 2 years. My target is next 3 years. Any big expenses that are coming in next 3 years that I need to worry about, I won't want to have that money in the market. Others, which I don't need for next 5 years, 10 years, 20 years, yeah, I'll be happy in keeping in the market. David asks, can I ask what percentage you both keep in cash when selling options? 50%. In current situation, 70-80%. Any general rules calculating that? So David, I'll answer it in 2 parts. So I generally share my pie at the end of a month. So let me bring that pie up. My latest one, which I shared for end of May. Where was that? My apple pie. Oh, just 1 second. Let me just go back and say, there we go. Right, my portfolio pizza. So let's open this up. This was my at the end of May. Right, I shared it in the slide channel. So my cash is 10% of overall portfolio. Okay. This is cash when this is a hard cash sitting in, say, bank account. Right. This is not the cash that is, this is outside of my emergency fund. This is investable cash. At end of May, 10% was in investable cash. Now, when you look at selling options, so that's why I said I'll address it from 2 perspectives. One is hard cash that I have at 10%. Now, when I'm looking at my options portfolio, I don't really care in terms of how much cash am I holding in that portfolio. All I care is how much buying power do I still have available to do further option trades? Whether that buying power is supplied by cash or that buying power is supplied by the stocks that I hold in that portfolio, I actually don't care much about. I don't differentiate too much between these two. So from the available buying power perspective, I have used around, I still have more than 50% of my buying power available. And that buying power may not have been completely driven by cash. The cash amount could be very less. I hope this makes sense. That's why I wanted to answer it in two parts, because you brought in when selling options 50%, 70%. I understood where you're coming from. So I rather focus on the overall buying power available. That I think I'll have to go back and look at what was in the end of May, but it will be more than 50%. Whether it was 55 or 60%, I don't recall. Yeah. So that would be my answer on cash. Okay. Steve says, if you bought at 2007 third quarter, stayed in the market, you will recover the first quarter of 2013, almost 6 years later. Yeah, so it took 6 years to come back. All right. Okay, so let's go back to our question. Hopefully you thought through some of your answers and can give me one company. So Sonia says, most of high-flying tech companies, Amazon, NVIDIA, Adobe, pick one. Sonia, if you can pick one and maybe talk through it, which is that one and why? So let me talk about mine. It's NVIDIA. For me, I want to, if NVIDIA comes down 25% from where it is, I'll be willing to put more money behind it. I saw NVIDIA has had a good run up pretty quickly in recent times, and that is why I hope if it comes down, I can basically invest a little more into NVIDIA. As we all know, NVIDIA had declared 4:1 split. For every one share, you will be getting 4 shares, 3 extra shares. And even though stock splits don't have any cause any fundamental change in the business, the overall size of the pizza is still the same. When we do a stock split, we are just cutting more slices through the same set of pizza, but market is not always rational. We saw what happened when Tesla announced their split, when Apple announced their split, and now NVIDIA has announced the split, and shares had a good run up all the way from 550 to 750 in a matter of not even a month. So now, if I'm waiting, if NVIDIA comes back, once the split has occurred, let me just open Thinkorswim platform, so that I can know when's the split supposed to happen. So once after split, hopefully this whole rally that we have seen, which is, I think in some extent driven by split, if it comes back down, I'll be willing to buy more of it. From a long-term perspective, a great company. Right now it is at $450 billion with the tailwinds behind it in terms of the chips. Now they are the leader in graphical chips. Now with the acquisition of ARM, this company has got lot more runway. I mean, this could become the Intel of 1990s. So I am long-term bullish on it, just that this $200 run up in a month, almost 40% up in a month. I think that's too much too soon. I'll wait for it for a little bit for it to come down 20% and invest more. Okay, Ramesh says everyone is waiting for Amazon to split. Yeah, I did hear on CNBC, they're asking a lot of questions to analysts on if they think that Amazon would split or not. I don't know why everyone is waiting for Amazon to split the shares. And the bigger thing is, I don't know if Amazon gonna do it. No, I mean, management hasn't given any hint. Analysts can say whatever they want to say, but there is no hint from management on if they really want to split or not. Okay, so Sonia says NVIDIA. Oh, okay. So I already gave my thesis around NVIDIA. Are there any additional points, Sonia, that you have and I haven't talked about? Will be, great. What's the additional bullish thesis on NVIDIA that you have? Okay, let me go to another one. Vijay says FB. So I want to talk through why Facebook, Vijay? Why is, let's pull up Facebook and see where they are. Yeah, I mean, I'm kind of a bullish on Facebook, but I'm not waiting for it to crash for now. Anyway, so I have some position in Facebook, but I am focused for now in a social media company. I'm looking more at Snap and Pinterest than at Facebook. That doesn't not mean to say that Facebook's not gonna do great. We analyzed Facebook's future growth opportunities when we looked at their quarterly results, and all looks good. But again, as a retail investor, I only have a limited amount of capital. So I have to make a decision between some of these social media companies. Where would I be more willing to put, my money? If I were to make decision between Facebook, Snap, and Pinterest, I already have position in Facebook, and I want to build more position on Pinterest and Snap. So I'm more focused on that. Okay, so Sonia said ARM acquisition. Yeah. Vijay, why not keep selling put spreads on NVIDIA? Sure. I don't have these feelings too often, but specifically for NVIDIA, after the announcement of split, stock has gone from 550 to 750. The new all-time high. I want to wait before I start selling put spread. Stock falls down 5%, 10%, 20%. Yeah, I'll be selling put spread on NVIDIA. Just not right now. All right, anyone else want to share any other stock that you are waiting for it to crash 25% so that you can pick more of it? Okay. Anyway, if there is an afterthought, we can always come back to it. Just put it in the chat and we'll get back to discussing that. Asi says Tesla. Great choice. I have kind of no comments on Tesla. Tesla is a great stock to trade. Again, this is my perspective. Sorry if it offends you, but I have a right to opinion on what I think about any company, right? So do you. So I have a kind of a love-hate relationship with Tesla. It's one of the top tickers for us in terms of, it's a money spinner. but I haven't yet become bullish on Tesla. I can't, even if it falls down 25%, I don't think I'll be, buying it hand over fist. But when I'll do a trade, I will give myself room that if it falls down 25%, 25%, that would be my break even. But interesting choice on Tesla. There's a lot of competition coming in for Tesla. So we got to be really careful. David says coin. Coin is Coinbase, the crypto exchange. All these are Tesla, Coin, all these are Aunt Kathy Wood's favorites. Coin has actually come way below from its IPO price. Yeah. So those who are not directly investing in crypto, this could be a proxy for a crypto economy. If right now the crypto market is kind of having its lull time, dull season, I won't say that crypto winter has set in, but it's not springtime either. So that's why it is reflected in the price of coin. And this would continue to mimic to a certain extent the way the crypto market behaves. So if you want to get exposure to crypto economy without taking a position in any specific, either directly crypto by buying coin or investing in some crypto trust, Coinbase could be one proxy. It is better proxy than, let's say, PayPal or Square if we want to get exposure to crypto economy. Coinbase is one, MicroStrategy could be another one. So I am not doing anything on Coinbase because I don't want any further exposure on crypto through this. I could directly take exposure in the crypto market. But coin is already way down. It actually hit 211. So I don't know if you will get another 25% down move in Coinbase or not. That depends on how the crypto market behaves. If the crypto winter really sets in, that may be a case. Let's see. I know this is not a crypto session, so we'll talk about that on Thursday. But let's have a quick look at it. Bitcoin is above 35, above 2K. Cardano is above 1.25. I mean, I wouldn't say that the winter has set in. I would still say the market has been oscillating within a range. Bitcoin above 30K. For me, it is still, if you want to invest, you can do your dollar cost averaging, continue to do your dollar cost averaging. And again, my thesis is really long term. I don't care where Bitcoin goes in few months or a year or 2 years. All right, so I don't see any more comments on that one. So let's move further. We'll come back to the stories later on. Let's dive right into the two biggest topic. I just want to make sure at least before the session, at the end of our 2-hour time period, we are done with this main content. Then we can talk about some market news. So 2 companies that I want to review today. Liz got it right that one of them is actually Confluent. The other one is a digital platform for doctors. Any guesses? The digital platform for doctors. Go ahead and Google. I never heard of this company before. No, that's a DocuSign. That is already IPO. These are pre-IPO companies. So I went through its S1 and looked through it. These plan to list on exchanges either the next week or after that. I don't know exactly what the date is. But these are the 2 companies we're going to review. So let's start with Confluent first. Again, one of them is a tech company. So my apologies if I getting a little deeper into tech. I'll try to explain it in a way in which it is easy for non-technical folks also to understand. But Confluent is a technology provider. So there has to be a tech element. I mean, I can't explain it without talking about tech. Okay. Meanwhile, you can think about what the other company is. So any software engineers here who have used Confluent products, do let me know. Its products are used by many, many companies. Okay, how many have you actually heard about Confluent and know a little bit about Confluent? May not have used the product, but kind of know which space does it play in. Steve says completely new to me. Okay. Okay, Asif got the second one guess right, Doximity. Okay, let's talk about Confluent. Any users of Confluent, either as a software developer or as your company actually uses Confluent product, or if you are from IT, you actually are managing Confluent products on-prem. Oops. Oh, okay. I don't see the name of that person, but someone from an iPhone says my company uses Confluent, but not me. Okay, fair enough. So probably it won't be unfair to say that this is a new company of Shannon. Okay, got it, Shannon. It's a new company for most of you. Okay. Asif haven't used directly, but looked into it for integration with our product. Cool. Yeah, this is what it does. It integrates the data. So let's talk about Confluent. List is data in motion. Yes. The closest one. Yes, that's the closest description is that's a company which is basically focused on creating product for data in motion. All right, so this is the S1. And let's review through it. Before I dive deeper into what Confluent is and its product is, let's read through some of the snippets from a letter from CEO Jeff Carr. It'll give us some history on Confluent. There is a saying that a fox knows many things, but a hedgehog knows one big thing. Confluent is a company that knows a very big thing, one very big thing. Now, the way it started is Jeff Carr and some of the other co-founders, they were working in LinkedIn, helping LinkedIn to rebuild their data infrastructure in late 2000s. What struck us at the time, that although there were 100 different technologies for storing data, right? We created data, we could store it in SQL servers, Oracle servers, MySQL. Our most acute need was not a problem of data storage. What we needed to do was to unite all the different applications and different data stores that made up a global social network into one coherent system. So you got different data stores, multiple databases where the data is stored. What LinkedIn's need was, and LinkedIn is a social media company focused on creating a social network, business network. People send messages on it. So their need was how to combine the messages coming from different internal systems. And there was not any product which focuses on movement of messages. I would say there were products, but not really that served their purpose. For example, TIBCO has been in this whole messaging platform for years. That's how they started with. I recall working with a product MQ messages. I don't recall if it is from TIBCO or not, maybe 10 years ago. There was a company called Business Objects. I worked on that. I think that taken over by SAP, which focused on moving messages. And going back to the older technologies would be EDI, electronic data interchange. That is like, you can talk about 1960s and 70s technology. But nothing existed for unstructured data that we get through our web, right? The data is now not only the text, it's not the set of columns and tables. It could be a message. It could be a like. It could be, and heart emojis. It could be a video. So none of that, there was no platform which allows you to manage the data, these messages coming in, and the data is of various different quality, different types of data. So what they did, they started to build it up. A small team consisting of Jun Rao, Neha Narkhede, and Jeff Cobb himself. They started building a project, started creating a technology, which they later became Confluent. So they created an initial version of a system called Kafka. And then it was open source. So those who worked in open source community, I like the amount of invention that I see in open source community. If you look at, I worked in both types of companies, open source as well as proprietary companies. And the amount of innovation that I see that happens in open source, the pace of innovation that happens in open source is amazing. I don't think any proprietary company can match the speed and the depth of innovation that I've seen in open source. So I became fan of really open source technologies once I looked at, the whole difference between open source and the proprietary systems. Things that used to take us a couple of years to add a functionality to our product, when I moved on to the open source, it takes 6 months, because now it's not dependent only on my team, not only dependent on a set of software engineers that I have in my company. Now there's a whole community that is working on it. So what they did, after creating an initial version of Kafka, they open sourced it under Apache license. And then these three kind of inventors moved out and created a company called Confluent. This company has been founded based to focus on Kafka and help other companies make use of Kafka. Okay. So this core technology was created in 2011, left LinkedIn and formed Confluent in 2014. Now, what is this Kafka? Right? Why do we need this? Now, this technology is something called a publish and subscribe system, right? Now, for example, hopefully all of us are familiar with databases. Those have been existing for almost 50 years now. You get the data, you store it in a database, and then someone, when they will need it, will query the database to get the results. Now, world has changed. The amount of the data, the variety of the data, and the speed at which the data is being created has grown multifold. And there is a constant stream of data that is being created. Now, if the companies have to depend upon storing all the data in a data store, could be Oracle, could be MySQL, could be SQL Server, don't care. Traditionally, that's what used to happen. You store the data in data store, then the applications will be reading from the data. No longer. We don't have a luxury of getting all the data into a data store, then modifying it, and then giving it to an application. That is too late. What the need of the hour is when the data is being generated, it needs to get onto the applications ASAP. We don't want to have a latency of having it stored in the single data store before it goes to the application. So there's a whole new concept. It's called data in motion, like Liz mentioned, that you are actually trying to deal with the data while it is being generated and being transferred. You haven't even taken it to your main database store. We all are familiar with the data warehouse, Oracle's or others data warehouse. There are a lot of companies, Teradata, all those companies, they work on data warehouse, where you take the data, dump all your data in your data warehouse. And that is called data at rest. Now the data is resting in your warehouse. It still has use of it. These companies still survive. But there's a new need of trying to look at the data, analyze the data while the data is in motion, so that you can make much quicker decisions and much closer to real-time decision making than having that data go in your data store, then you extract, then you run your intelligence on it, and then take a decision. So that's where the Kafka comes in, is kind of provide a messaging platform from the source of data generation, goes through Kafka. Kafka, here's the source could be, let's say, stock exchange is producing the data. Now, there could be companies who want to subscribe to that data. I want data feed. I want options data. I want to look at a end of the day data, end of a closing price data, right? So there will be multiple subscribers who will subscribe to that data. Now, this Kafka sits in between to manage the data coming from producers and sending it to subscribers. Right? There are more details in Kafka in terms of how they do it. Kafka clusters connect. I'm not getting into those details. Just simple understanding is publishers publish the data. Now the subscribers want to subscribe to that data. The quickest way is in between sits Kafka, which basically manages the whole publish and subscribe system. So that's what Kafka is. So mission statement for Confluent is, yes, set data in motion. Pretty simple, hopefully easy to understand. Now, the problem that he's trying to solve is for companies to compete in business, the operations of business need to happen in real time, not only against just one line of business, not only based on the information that you derive out of your US data stores, but how about your European? There is a data generated from your European operations. So you need to look at the data across geos, across line of businesses, and connect them all together to make, and that too, to do it in a real time. Not that you dump everything into a data warehouse, data coming from all different geolocations, different line of businesses, and then take a decision. Those all need to happen in real time when the data is being actually generated. So that's the problem it's trying to solve. So traditional data infrastructure is not designed for data in motion. Rather, it is architected for data at rest. We got the data, dump everything in a Teradata or Informatica or Oracle or SQL analysis server. Pick whatever technology you may like. Or some new ones which are NoSQL databases, time series databases. But they all work on the data that you brought in at rest. But the need is to integrate it in real time. So the data infrastructure must support continuous flow of data from across the organization and build applications that react to that real-time availability of data. So that's a problem which Confluent is trying to help companies with. Pictographically, this is your data at rest. There are different data warehouses. You run your queries, application run the queries, or you do your batch processing. And I've been I would say, kind of a victim of the slow daily batch processing. I can talk about from my experience. We had tons of data, and our customers, you need to get the data from us. We used to run batches in the night, run the whole batch processing, and 5 a.m. Pacific time was when we used to kind of send all the data all to the customers, because we didn't have Kafka by then. What Kafka is trying to do is to convert it into a real time. You don't have to wait until you put it into your big data store. It's a real time data stream processing. So their vision is that every data generated in your modern enterprise, Kafka could become, or Confluent could become, a central nervous system of getting the data, sending it to whoever wants it. Total addressable market is really big because we are generating data at a huge, the pace of data generation is mind-boggling. So is a total addressable market. Overall, Gartner says that these four are the big areas of data infrastructure, total $149 billion. These all are on the roadmap of Confluent. Currently, their product is targeting the $50 billion of this total market opportunity. So I would consider that the TAM is $50 billion. That's what the company says. The total addressable $50 billion. This year, last 2020, they've done close to $250 million in revenue. So still huge growth, possibility of growth available for this business. Details of Kafka, I'll skip it, but let's understand what the products that Confluent provides. Of course, the core or the base underlying is Kafka, but Kafka is open source. You and I, we can go and download Kafka from here. That right there, it says download Kafka. This is the latest release notes, source download. I was not too big, but if I want to download, there we go. I can download from any of these places. I don't have to pay anything to anyone. This is open source. But Confluent also have some proprietary closed source, or again, this is more of a legal differentiation between the classification of different softwares. And many of these open source software companies started to change their licensing model after Amazon started to eat their lunch, right? Kafka is open source. Amazon engineers are actually working on this. They are also providing services to this. So how does Confluent differentiate itself? They got something which is proprietary code. Others can't use it. They got an interface for developers to query the stream of data. Now, this is little difficult to understand that traditionally we understand how to query a data is you have a database, you run a query on it. But now we have to run a query while the data is in motion, right? So that's what KSQL DBA provide. They've got a control center which will manage the whole in between Kafka stuff, the services of Kafka or servers of Kafka, plus a bunch of others. Now, big question, if it is open source, how they make money? They make money by selling the subscription services. Now, they have two type of kind of a products. One is Confluent Platform. So this whole Kafka that sits on the servers called Kafka cluster. What Confluent provide is something that you can download from Confluent website. It's called Confluent Platform, which you can now deploy that software onto your own data centers. It's like you download Office, not Office 365, but the Office license software. But then you're responsible, your IT team is responsible for managing that Office software. If a new feature comes in, IT team has to go and update and get those new features onto for all the users. That's a Confluent platform. The second one is a Confluent Cloud. This is Office 365. If a new feature has come in, new security update has come in, my IT team has to do nothing. I am accessing it from a cloud, from Microsoft Cloud, Azure Cloud. Microsoft will take care of making sure that the latest security patches are in, all the new features are turned on. My IT team has to do nothing about it. So that is a fully managed cloud native SaaS offering available on Google Cloud, Amazon Cloud, as well as Azure. As a customer, if I have a relationship with, and I have most of my data on AWS, Amazon, I can still sign up and become a Confluent Cloud customer because the services is available on AWS. If I don't have data on cloud, my data is sitting on my data warehouses, or all of my systems are on my premise in the data centers that I own. In that case, I'll basically buy Confluent platform from Confluent. Now, they make money through customer support, little bit of licensing revenue, customer support, and maintenance and upgrades on Confluent platform. So it is like you sell a CD, of course, no CD. Now they download the Confluent platform, but you sell them software, get some license revenue, and then you also buy a support from us. Because if you're running mission critical data, you're running your business on it. If something goes wrong, you want to make sure that you can get a support and get fixes. So these companies will buy these products, then they'll buy support seats. I want 5 support agents, or based on whatever. So, and generally these companies will have a tiered support structure. A substantial majority of subscriptions have 1-year terms, which is surprising to me. Many of these companies generally have 3 years. Now, other is Confluent Cloud. So you don't have to manage it. It's managed by Confluent. So it is either month-to-month basis, pay as you go. If I'm using it, I'll pay you on month-to-month basis. Or I could enter into a minimum commitment contract for 1 year, usage-based. So the pricing will be more favorable in here than it is here. It is like I'm getting into a lease for a year, or I want to do month-to-month. So customers will generally start with a free cloud trial. Then once they become comfortable with the Confluent platform, they'll say, oh, I'll convert to a paying customer, become pay as you go, or I could take a minimum customer contract. This is how the cloud journey will start. Any questions? Let me look at. Sounds it may be bought by bigger players in data management. Possible. We'll talk about who are the other players in this. Okay. Founded in September 24, announced Confluent Platform 1.0 in 2015, then started creating Confluent Cloud in 2017. That is actually earlier than some of the other companies. Then 2019, September 19, 50% customers are on Confluent Cloud, which is a pretty good number. Moving all this 50% of our customers to Confluent Cloud. November, it's available on AWS, Google Cloud, Microsoft Azure. And then March 2021, they exceeded 2,500 customers. From a high level number, 51% Q1 revenue growth, 2,500 customers, 560 customers with more than 100K annual recurring revenue. But still loss-making company. It's okay. If they're growing gangbusters, we can forgive those losses. Most of these SaaS companies, they don't make money until very late in their life cycle. So no different. Okay. Let's look at management. Experience of management is, I would say, they are tech competent. No one could understand Kafka better than them because they invented Kafka. From CEO, is well liked by the team as well. Glassdoor rating is also good. Also, management has got good skin in the game. If you look at Jay Krabs, he owned almost 12.6% of all the outstanding shares. Founders are still around. I like the companies in which the founders are still there. They had the initial vision. They are bought into that vision. And at least two of these founders, they are directors, Jay and Neha. So founders, they do have, and the management have big skin in the game. Now comes the real part. What financials? How do they look? So overall revenue around 240 million. I'll just round it off. Overall expenses 394 million. So it's a hugely loss-making company. They lose almost the same amount of money that they actually sell. Their expenses are almost double its revenue. So I would say this company is losing money hand over fist. It's okay if they're still trying to grow their business. This is a new technology. They have to invest and educate their customers about this technology. So huge loss. First point to note. Free cash flow, negative 86 million by end of 2020. So it's losing tons of money and negative free cash flow. Okay. Balance sheet, if you look at a balance sheet, total current assets, end of 2020, 427, cash equivalents, 36. Okay, current assets, 427. What's the current liabilities? 193. So if I look at available working capital, is close to $205 million. They have $205 million available working capital. Their expenses last year were almost 400. Where are they going to get the money from? I see. Maybe that's the reason why they want to go IPO. Because they need money. I mean, nothing wrong in that. I want my companies to go IPO because they want to go IPO, not that they have to go IPO. In this case, somehow I'm getting a feeling that they are deciding to go IPO because they have to. The financial shows it. And till now, they've accumulated deficit of almost $450 million. So Vijay says, who are the VCs? We will talk about that. Investing in VCs, investing in Confluent. Yeah, I have a list of VCs. Again, I could directly jump on to conclusion and give you what my conclusion is. But then that's like, what do you call that? That's a saying, right? Don't give the fish, teach how to fish. My intent here is not to just give you the end result, but take you to the thought process so that you can create, you might have a different opinion than what I might have. But I want to take you through the thought process that I go through it, and then I come to a conclusion. So idea is, you could have those facts, you might come to a different conclusion. Okay. Sales and marketing 3x in 3 years. Is that normal for a SaaS company? This company hasn't been very effective in their S&M operations specifically. So their, the efficiency of their sales and marketing hasn't been impressive at all. All right. Let's look at the competition as well. So we talked about the technology, great inventors. They invented the technology. How about competition? So there comes the biggest concern. Their competition, number one, is internal IT team, who can do it themselves by using open source software. Same was the case with few other open source software companies that we are aware of. In similar space, in data space, was Hortonworks, was open source. Struggle with it because customers will go and download and manage them themselves. If your IT team is a little smarter, they can do it themselves. They don't need to have your UI. The whole idea Confluent does is give you like command center to control it easy, give you UI to manage all those Kafka servers. Actually, it's called clusters in easy way. But if I got a bunch of software engineers who can build it, why do I need to go to Confluent? The biggest competitors in the cloud are Amazon, Google, and Microsoft. These companies are developing and releasing fully managed data ingestion, data streaming products like Azure Event Hubs, which competes with Confluent Cloud. Amazon has got Amazon Kinesis and Amazon DynamoDB streams. And Google has got Cloud PubSub and Cloud Dataflow. I think now these are really big competitors with deep pockets. What happened to Hortonworks and Cloudera? These cloud players kind of ate their lunch, and that's why Hortonworks and Cloudera merged. Now Cloudera is pivoting towards cloud. Because if customers have understood that they don't want a software that they have to manage on their own. So Confluent platform, that is more than 70% of their overall revenue. But Confluent platform is the one which you have to go and install and manage on your own, on your data centers. You might want to get a support subscription, but still you have to manage it. Customers know and have been spoiled by all these cloud services wherein I don't have to manage. I'll just subscribe to your cloud service. So Confluent has started their journey, but that portion of revenue is very less still. Whereas these big cloud competitors have built in huge services which does the similar thing. For on-premise, there are other vendors like TIBCO. I talked about TIBCO earlier. TIBCO was in messaging. Now they're also moving into this streaming. Cloudera has got Cloudera Dataflow, which uses Kafka plus other technologies. Red Hat has got it. Oracle Cloud have it. So they got a competition in cloud, of course, on-premise. And lastly, there's a competition in the technology itself. Kafka has been great, but new technologies keep coming. There's a new open source project called Apache Pulsar. And now we are seeing many companies are actually using Apache Pulsar for doing what Kafka does. Splunk, data stacks are now using Apache Pulsar. Open source, pace of innovation is really high. You have to be always on your toes. So now Confluent whole business is based around Kafka. And now if there are better technologies than Kafka itself, that kind of tones down their, I would say, proposition. Okay. No customer concentration, which I'm good. No management misfits. No issues on IPO proceeds. That's all good. Money raised, they're trying to raise almost $700 million. So once they raise $700 million, they'll have overall, close to $1 billion available for working capital, which is good for next 3-4 years. Offering 23 million at $31, valuation of around $7 billion. Someone asked me who are the VCs. These are some of the VCs: Benchmark, Sequoia, Index Ventures, all great, well-respected VCs. Of course, VCs also see where the puck is moving. Maybe they want to get out before it's too late. Who knows? Right? What's the motive of going IPO? I can only look at based on what I see in their S1 and based on what I feel happening in this market on this whole data in motion. So my conclusion around this is open source. And because Kafka is open source, there are a lot of companies who are providing the Kafka service as platform as a service. We saw Amazon doing it. We saw Microsoft doing it, Google doing it, Cloudera doing it. Okay. Now, Confluent does have some proprietary stuff. When we looked at the products, there was some proprietary stuff also. One of the big of proprietary stuff is Kafka streams, but it is not available in their cloud offering yet. Where customers are moving to cloud, but Confluent doesn't have everything on cloud just yet. They got a Kafka streams, which is still not on cloud. So if as a customer, I have to manage myself, then not a great position. Okay. Financials, we've already looked at. This is another tech challenge for them, Kubernetes. Again, getting it a little more technical is Kubernetes allow customers to spin up, start Kafka in cloud. Why do I need Confluent Cloud? There are other reasons, because they'll give me a little more management tools around it. But again, they could be disrupted. They disrupted a tech, now they could be ripe for disruption. Okay. Free cash flow is negative. They're losing money hand over fist. Okay, one more point. In cloud, Kafka clusters could become cattle from being pets. Generally, in this space, we talk about some technologies or as a pets and cattle. Pets means you have to take care of them. You have to feed them. You have to put time behind them. Cattle, leave them open in the wild. I don't care much about it. They'll survive. So when you're having stuff on your on-prem, those are pets. If it goes down, you have to make sure that you have resources available to bring that back up. You have to have enough disaster recovery. If one of your server crashes, you need to make sure that there's another one to take over from it. Those are all pets. When it moves to the cloud, I don't have to care about it. If a cluster goes down, these cloud providers provide enough availability that if one dies, the another one will come back up. Cloudera faced with these issues. The moment Amazon started with their EMR and Azure had Azure Insights, the customers who are holding and deploying software on-prem, why do I need to take so much of attention? I'll just buy cloud. I don't care if one of my server has gone down, it'll come back up immediately. So then I don't need that whole in-depth management, because I don't care if one of the, it's in the wild. I don't care if it goes down, because it'll come back up. So Kafka clusters could move into the same way as like Hadoop clusters have done. Again, technology that Hortonworks and Cloudera had perfected. And now kind of their lunch being eaten by these cloud players. Kafka tech is fine. dig deeper. This is not a huge piece of overall data management project or a data management initiative. When as a customer, I'm going to change my whole data infrastructure, this whole Kafka is just one piece. Even though Confluent would like to say that we are the center, reality is different. Right? There are some vendors who will just throw these Kafka management service for free, because that's not the biggest portion of the deal. I want this deal, I'll give you Kafka. Because take data analytics from me, take data store from me, take data ingestion services from me. Oh, you want this messaging Kafka? I'll give you that for free. This is not the biggest deciding factor when any company wants to revamp the data infrastructure. So the revenue for Confluent is limited. And as far as you look at valuation, it is seeking premium at IPO. But it is growing at a higher rate. So some of that growth or some of the premium is justified. But I think looking at all these factors, that they're losing money hand over fist, they have a limited working capital, they need money. If they continue to run operations for next few years, huge competition coming from cloud. The fact that 50% of their customers are on cloud and still the cloud business, revenue from cloud business is very small. Now I'm concerned on how quickly can you grow that cloud business? And that's where the puck is moving to. So great tech, huge competition, not the biggest portion of the pie when it comes to decision making. Losing money hand over fist, I'll watch from the sidelines. So that's my end and analysis of Confluent. Does that make sense? Does this the methodology make sense in terms of how we go through it and trying to understand, dig deeper, looking at the numbers on whether we should invest our money or not? I mean, they got great VCs. But again, when it comes to VCs, they would have made their money. Overall, they've raised $574 million. So even if they go list at 31, which it won't, it's a tech company, it's a data management company, it's a SaaS company. These three keywords are enough for initial IPO pop. These VCs will make tons of money anyway. But we have to think whether it's a good buy at whatever the pop happens. For me, I am not yet convinced that I should put my money behind it. Samuel says, what happens to IBM Cloud? Yeah, when we talk about cloud, nobody talks about IBM Cloud. I mean, IBM do have a cloud. It's still there, but doesn't even come into picture when I look at a cloud cloud services providers. The biggest is, of course, Amazon AWS. Second comes Azure, Microsoft. Third is Google. Now the Oracle has taken a huge lead. They got some great customers, Zoom, 8x8. And Oracle has been building its cloud infrastructure really quickly. And that's what it showed up in Oracle. Look at their stock price. I mean, in the latest results, it fell down because the guidance on the cloud growth was less than what market would have expected. But last 1 year, even since they have been trying to focus and build their Oracle cloud, it's up almost 50%, more than 50% in 1 year. That's all this growth is because of Oracle cloud, nothing because of the Oracle database, which is growing at about 3%, less than 5%. Steve says actually Red Hat is doing really well. Yeah, Red Hat is one open source company, one company that built their business on open source. Now, every other company that is trying to build business on open source, the question is, would it be next Red Hat or not? Yeah, so Red Hat did good, but I think overall IBM Cloud, they are not much in terms of a competitor to any of these, the other three big cloud players. IBM is getting into it. That's why, Krishna is divesting on in businesses, or they're kind of separating the businesses so that they can focus specifically on cloud. Well, it'll take some time. Too much competition in the cloud business. Yep. All right. Anyone whose mind I have changed, if you knew about Confluent and trying to, yes, I'm going to do it, investing on the day one. Did it change your mind? Again, you have a right to your opinion. So if you want to go ahead, go ahead. I mean, I'm talking about what my opinion is and how I would want to do it. Okay, Asif says detailing useful analysis. Agree with you that it doesn't seem super exciting opportunity just yet. Correct. Tech is exciting. As a business, I still want to see how this company can grow. Right. All right. Let's get into review of Doximity, ticker symbol DOCS. This was a company that I never heard before. I started reviewing its S1. So you can kind of call it as started as a LinkedIn for doctors, as a network for doctors. Want to look at an S1 document? Got a link for S1 document. What's the company mission statement? Help physicians to be more productive and provide better care for their patients. I think everyone can relate to this and can stand behind this mission statement, which is what I like. We are physicians first, focus on physicians' comfort, putting technology to work for doctors instead of the other way around. There were some numbers that I read earlier, not related to this S1, but I think in a Wall Street or somewhere, where they were talking about how, I never thought that, that was a reality, but how stressed the medical professionals are by the amount of a paperwork that they need to manage or the workflow. So Doximity is trying to help them, provide them a tools to manage their workflow properly and, put more focus on caring for their patients. So some of the problems it solves is fragmented systems. Many systems in the hospitals are old, or not even hospitals, even if you go to the doctor, their individual practices, they're still working using fax. Reams of paperwork. You go to a new doctor, they'll ask you to sign a form, take all your history on a form. A lot of paperwork is still happening. So there are a lot of challenges for medical professionals. They have antiquated systems, difficulty in maintaining control, quality control, difficult to stay up to date on what's the latest research happening, blah, blah, blah. Challenges for pharmaceutical manufacturers. Declining impact of in-person calls. It's very difficult to get time from doctors to go and pitch them for new drug. Right? Challenges for health system is lack of effective channels to enhance brand awareness, to attract new patient referrals. Recruiting channels are largely offline, even though LinkedIn is there, but LinkedIn has got everything. It's not focused specifically on medical professionals. So it's a network, professional networking for every type of jobs. Right? It's like there are CRM systems. Salesforce is one, the biggest, the big daddy of CRM. But then we got a Viva systems, which is focused only on not really pharma or the drug kind of pharma. Yeah, pharma and these biotech companies, which provides a CRM which is very focused only on that particular industry. And Viva Systems have done great. I regret not investing into Viva. So targeted niche market systems can also survive. Total addressable market, physicians are key to decision makers. They are more than 73% of the total US healthcare spend is directed by physicians. 78%, not 73, feel professional burnout. So what Doximity does, they got tools for medical professionals. You got a professional network. This is where the LinkedIn stuff is. I can create a profile, connect with other colleagues, search for jobs, manage my career, or if I'm a practice who's looking for medical professionals, I can go and look and hire the best professionals that I want to. Then they also got a news feed, articles, latest happenings, what's happening in this world, what your colleagues are up to, some clinical discussions. Then productivity tools, e-signature, digital fax. Doctors love fax. Secure messaging. Then voice and video. You can connect with your patients with voice as well as videos. Telehealth. Right. So, multiple tools. LinkedIn for medical professionals is the largest medical professional network in the nation. They claim to have 80% of medical professionals on their network. Career corners for the new medical professionals. We got a career navigator. We got a residency navigator. If I'm a medical student, I need to look for residency programs. You can search for it. Catch them young while they are still in college. Of course, news, article, medical videos, you can watch all that. Peer-to-peer communication between colleagues. I have a patient with some peculiar symptoms. I can chat with my colleague or with my other peers, with my friends, all within this app. And of course, they got a secure tools for fax and messaging and dialer, all that. Now let's look at some. Meanwhile, if you have any questions, throw it in the chat. And anyone from medical professional community, please pitch in and give your feedback if you are aware of this and you have used or your friends have used this or not. Let's look at some of the numbers. So before that, how do they make money? We offer marketing, hiring, and telehealth solutions. So for a pharma company, getting access to 80% of medical professionals, that's huge. You can't have such a reach by having, boots on the ground, by just having all your medical reps trying to reach out to them. Same is the case with the hiring. Once you got this big network, you can basically make use of that network for someone who's trying to hire. And lastly, the telehealth. And surprisingly, this telehealth actually was an afterthought. They didn't have this product, they started talking about and building this product only in 2019. They had their first version out while they were in COVID. So this, an afterthought, is now added, huge usage of their overall platform. So their customers are not doctors. Doctors are users. Medical professionals are users. Customers are their pharmaceutical companies. Their healthcare customers. Some cases it could be hospitals as well, who are trying to hire medical professionals, but mostly pharma companies. So 2021, they had over 600 subscription customers, out of which 200 contributed at least 100,000 and 29 contributed at least $1 million in subscription. So 29 customers contributed at least $1 million. So number of customers are not too big. You could say 600, that's it. We looked at a Confluent, they got 2,500 customers, but different business. How many pharma? I mean, there are only limited number of pharma companies or the healthcare big companies. There are not too many. That's the business segment that they operate upon. Overall, big high level numbers, 80% of US physicians are on their network. This blew my mind. 63 plus million telehealth visits. 63 million. As a comparison, I think Teladoc did what? 12, 15 million? I mean, how come I have never heard about this company before? In telehealth, we heard about Amwell. We know about Teladoc. Those are two big players. And then there are a few doctors on demand and stuff like that. And we had the list of a competitor when we did a Amwell S1 review. Doximity, I never heard of. Of course, there's a difference. I want to be pretty clear in terms of what they call as a telehealth visit. When you look at a Teladoc or Amwell, their telehealth visit means the physician you're in a call with physician to talk about your health concerns. Could be video, it could be just audio. But Doximity, even if they send you message, they consider as a part of their telehealth visit. But nonetheless, even if we discount for that, this business, which was an afterthought, only came into being, early 2020s. It's a huge number. And their net revenue retention rate is 153%. Confluent number was 117%. And here their rate is 153% net revenue retention. Means the cohort of the customers that they had 1 year ago who spent $100, now they're spending $153, even after accounting for, some customers who might have dropped off. Taking care of everything, all the drop-off customers, still their retention rate is 153%, which is great. One of the best. I don't see this number in many of the SaaS companies, generally 110, 20, 30. Maybe Snowflake had NRR closer to 150. Huge. This is the revenue growth, 78% from 2020 to 2021. Yeah, like I was saying, they launched enterprise telehealth as an afterthought to COVID-19 and still were able to get 63 million engagements through their telehealth. Now let's look at what's the strength. Do they have any moat? So they have a little bit of a regulatory moat. I would say this could also be a challenge because this medical industry is a regulated industry. Things what could happen in Congress could upset your business, but it could also serve as a moat. If you know how to be HIPAA compliant, if you're a trusted provider of a solution, any new company coming in have to jump through that hoops of regulations. So all their communication solutions are HIPAA compliant. No company would want to take over or buy a solution from a newer company that haven't proved themselves that yes, they can withstand the regulatory challenges. It's the largest platform, largest network of medical professionals. So we got a network effect here. The network effect both to medical professional as well as to pharmaceutical companies. Pharma companies will go where the most of the medical professionals are. High switching cost. Again, these are the different levels, areas in which we can analyze the moat, network effect, regulatory or IP patents. I don't think they have a patents. So, and there's high switching cost. If you're deeply embedded in a workflow, then physicians won't like to completely switch over to a new one. That's difficult. That's like ripping apart what I'm doing and trying to bring something else new. So if I'm comfortable for using Doximity in my day-to-day workflow, once you become comfortable, then it is very difficult to rip apart and replace. Physicians' main focus is to provide healthcare, not to get onto the latest and greatest tech. They want a tech that works. They want a tech that works smoothly. As long as that happens, if any new coming in, they won't just jump onto the latest tech. If it's working, if it's not broken, why change? So there is high switching cost. Plus, they also have a knowledge moat around them, because the founders are actually from medical professionals. The founders themselves were doctors. So they understand physician workflow really, really well. And it is different from the other, regular technology workflow. Their product leaders are physicians. There are designers, engineers who are familiar with these healthcare services. And this being very specific area of expertise, they do have their knowledge moat around, I would say the build body of knowledge around the medical professional. This is similar to the knowledge moat we talked about when we looked at chip manufacturing. There's a lot of a tribal knowledge that has gone into chip manufacturing steps or recipes as these foundries call, which is difficult to rip and replace. Same is the case here. Now let's look at management. CEO had another medical reference business before. He sold it to Athena for 300 million. So he's already rich. He's not just doing it. Money is not the sole factor while running this company. He had sold another previous company to Athena for 300 million. So he's been in this business of tools for physicians. Earlier it was a reference, build a tool for medical references. Now building it for a different reason. Been there, done that. Let's look at skin in the game. And my apologies, I just wasn't able to get a better screenshots over here. So if you look at the Jeff Tanzany, prior to offering 32%. So even after the dilution after IPO, they'll still have a healthy stake in this company. Okay. Let's quickly look at a P&L statement. Overall revenue, 21 year ending March 20. So their year ends on March 31st. So we got 3 year worth of data. 2019, 86 million, 2021, close to 205 million. Almost 2.5x in 2 years. So $206 million of revenue. And unlike a lot of other companies, they got $50 million of net profit. When was the last time we saw a pre-IPO company actually making a profit? And this is not just making profit. We're making profit, gangbusters profit. $206 million overall revenue, 50 million net profit, not even gross, net profit. It's like 25% net profit. Here we're talking about a company which is financials are, I would say, mind-blowing. They got a free cash flow of $78 million. Yeah, so net profit of 50 million on $206 million revenue. That's amazing. Along with the type of a growth that they're seeing, you could argue saying, yeah, they're focused on making it a profitable business, but not growing. That's not the case. They've grown from 116 million to 206 million, almost 70% growth, and growing their profits as well, double the net profit, and almost triple the free cash flow. So they're growing and profitable business, and not just profitable, but huge profitable. All right, nothing more detail. I don't think there was anything which stands out on cash flow or balance sheet. How about their competition? They are not the only one. There are other players, Sermo, Daily Rounds, none of them are public, but this is not the only company where medical professionals go and sign up for. Why only Tinder? There is Bumble as well. So why only Doximity? We got Sermo too. And of course, the other telehealth providers, because now if their telehealth business really, takes up at the same pace, they will be entering into where these other big players are, Teladoc and Amwell. It started as an afterthought, could become one of their biggest business, who knows? So till now, I'm pretty excited when I look at this company, and when I look at a Confluent, as we reviewed earlier, I'm like, okay, there we see the vast difference. Confluent annual revenue was 250 million. This company is not far behind, 206 million. But their losses were 200 million on it. And this company's got a profit of 50 million. Okay, I see a question. I may have missed, but how do they make money? Let's go back. How do they make money? How do they make money? AKA business model. They offer marketing, hiring, and telehealth solution to pharma companies. So for example, the way it happens is, if I'm on their solution, pharma company can send me messages or ads. So what Doximity does, they don't charge medical professionals for creating their profiles and using it, but they charge pharma companies, telling them we got 80% of medical professionals, 80%, on our network. You could reach out to them. So they have a marketing solutions, and pharma companies are willing to pay them. There are 29 companies that are paying them more than $1 million to reach out to their network of physicians. Or they have a hiring solution. I want to hire a medical professional for my practice. I can make use of Doximity solutions. Or the enterprise level telehealth. I'm a hospital. I don't want to go through Teladoc, super expensive, whatever the reason. I want to, or I'm a small practitioner. I want to have telehealth build up as an enterprise. They got a telehealth solution. So this is how they make money. Okay. Hopefully now it's clear, Asif. All right. So that's how they make money. They have 600 paying customers. 29 of them pay them more than $1 million. 200 paid them more than $100,000. Okay. What we need to be aware of. CFO. She is very young. I have no concerns about, young age, but the bigger thing is she has no accounting experience. Again, I don't want to hold it against her. I think she graduated in philosophy, and then she was a finance strategy head and have been recently made CFO. She's just 31. And the previous CFO lasted less than a year. Generally, if a CFO has some accounting experience, is good. But again, I wouldn't say that this is a red signal for me. Something that you to be aware of. Other thing, it already is on a high profit margin. We looked at $50,000 net profit and $50 million net profit at a revenue of 206 million. Already good profit margin. Is there a room for further operating leverage? Can they squeeze in more profit from the same revenue? That's what operating leverage is. Through operation, now kind of a better leverage my profit margins. Or will the profit growth will have to come from revenue growth? So that's, again, not to be, I won't ding them on that. You already made too much money at your young age, at the early stage of your company. How much you're going to grow? I'm not going to ding that. Something to be aware of. Customer concentration, not too high. Largest customer account for 12% only. It's not too big. I would be concerned if it was like a firm where, not Palantir, what that cycling machine? Peloton. Peloton was 30% of a firm's revenue. And we all noticed what happened to a firm when Peloton had to do a recall. In this case, 12%. It's okay. But what I didn't find in S1 was this being a network company. I know 80% of medical professionals are on your network, but what's the usage? All the social media companies are valued around active usage, monthly active usage, daily active usage. I didn't see any numbers around it. So that is a little bit concerning to me. It is easy to get all the people to download app and create a profile on your app. How many of them are actually using it? I couldn't see any numbers around that. I did see some chatter in media saying, creating users, it's easy. For example, sometimes they scrape the profile of doctors. And there was one person who was saying that in their company, which is in a healthcare, they say we were asked to create profile in this. If we were to give a rating to other doctors, it says, after that, I've never used it. So it will be interesting to see what the active usage is. I didn't see any numbers around it. So maybe the numbers are not the best ones. Who knows? But I would say, if out of all these, if there's any one factor that I'm a little concerned about, is missing metrics around active usage. And this is a number that I would want to look in future. But, the proof is in the pudding. Numbers look great. The financials look great. So we'll wait to see what their MAUs or DAUs are. No management misfits, no harassment cases, no felony, nothing else, no issues in IPO proceeds. One good thing I found was that they did mention that they could fund their growth strategies. Maybe they look to acquire something. They acquired one company in 2014 or 16. But again, nothing that's stand out as a red flag in IPO proceeds. Valuation. Now this is different. Current valuation at the mid-range of this price is 4 billion. Is that hot? To me, 4 billion looks very reasonable for the amount of revenue this company has, the growth that company is having, and the profitability that they're able to generate. So to me, this is one company. This is, I think, probably the second company in my investing in US is that I'll be okay to invest on day one. Hopefully, it doesn't get become double on IPO. So lastly, conclusions, highlights were it's a mission-driven, solving a real problem. It's a founder-led business. They got a lot of optionality. So right now, they're not even targeted medical devices company. They're looking at pharma companies. Medical devices have the same need like the pharma companies have. And they can expand. They got optionality in front of them. Telehealth is a big optionality. It just started as an afterthought business of COVID. It could become a separate business of its own. Right. Lowlights, we talked about it, missing metrics, already at a high profit margin. How big is the pie? They say their TAM to be $18 billion, but I don't know if all of that is capturable or not. We don't know how it will work outside the US. So is their whole business only around US, or how is the outside of US? But again, something to be aware of, not dinging or deducting any points from this company on this. So this one, I was pretty excited about it. I don't know about you, but when I looked at these numbers, I'm like, how come I didn't know about this company sooner than, only 2 days ago? Well, I was trying to figure out, okay, which companies are coming IPO and want to review it on Saturday meeting. Ramesh said, what's their symbol? Symbol is Docs. Doc symbol is not yet taken, DOCS. So if say pharma companies spend tens of billions on marketing, so as long as they keep Docs on their platform, they can mint. Yes, that's true. Again, I'll be more interested in seeing their active usages, because once you got 80% of your doctors on your platform, from the increasing the number of more users, you got only 20% left. But the idea is how you curate, how you grow that in the current users into using your application more and more. That's the number I want to see it. So the only thing that I feel missing is an active user number. That wasn't really apparent in any of the metrics that I was trying to look for in their S1. Ramesh says, one does not have to know everything. They can hire smart people to do it. Yeah, absolutely. Yeah. So, I just brought forth something that I don't see in a company that is about to go IPO, has got such a young CFO. And now we all understand, right? Now this company coming IPO, every analyst, forget analysts, even people like me will be looking at the financials, and she'll have to answer all the calls from all the analysts. So, and if you just that it sounds that she didn't have an accounting experience, not that it'll go against her. It's something to be aware of. Yeah. If it was not CFO, if she was anything else, because CFO becomes a face for the Wall Street. That's the only reason. All right, so that finishes our analysis on Doximity. DOCS is the ticker. Any questions on Doximity? And there goes our 2 hours for today. So I will skip going through, what happened in the market. I'll jump onto option trades. And because we haven't talked about in almost 2 weeks now. Last week I was off. So I want to just look at the option trades and then finish the session. Meanwhile, any questions? I'll sip some water. What's your thought on Doximity? Again, don't go and invest and say, oh, Vivek told that he'll buy it on IPO day. Again, do your own homework. Check what else you might have in this portfolio. I kind of had a bittersweet feeling for this because I'm a shareholder of Telador. I'm like, damn it. are you gonna kill my the Teladog positions? But I like what Doximity is doing and how they're growing. I will be interested like SoFi. Cool. All right, so let's. So these are the two pre-IPO we reviewed today: digital platform for doctors, Doximity, and Confluent, company that focuses on data in motion. My thought process: Confluent is wait and watch for at least a quarter, 2 quarters, and see what they're going to perform. This one, I may be willing to invest it sooner. Again, we'll wait, let's see when the options are available. Because 4 billion valuation is good. That is what, 16 times price to sales. And they got a profit. It's a net profit company. All right, let's jump onto the option trades. What we did. So this include 2 weeks time. In the last 2 weeks, overall, we closed 13 trades, opened 15, which is more than usual because last 2 weeks were the perfect time. And I won't say perfect, but it's an optimal time to open trades for July expiration. So I was a little more aggressive in opening trades. Now I am a little more choosy because now we are less than 30 days, 28 days to July expiration. So now I'm a little choosy when to open, when opening trades for July expiration. So this week and the next week, gonna be a little dull in terms of opening new trades. But last 2 weeks was more active. Highlight, Tesla winning trade. Again, I've been trading Tesla almost every expiration period and have enjoyed decent success with it. So I like Tesla as a ticker to trade. Earlier there was a question around, I think Asif mentioned that Tesla is one company you'll be willing to buy at 25%. Even though I always, when I do a trade, I do it with an assumption. If it falls down 25%, I'll be okay to buy. But at the back of my mind, I always have this concern on Tesla around the competition that is coming in and the headwinds that Tesla has. But why not trade it? It's been working out over and over again. So till date in this year to date, kind of made 50% return on investment on Tesla, which is decent. So that's a highlight from an option trade perspective. Okay. It's not last week open trade, but since we met 2 weeks ago, we had these 2 trades that were open. Let's bring that up. Hold on. Where's my thinkorswim? Just give me a moment. What was the Tesla trade? Options? Yes. So these trades all we discuss are only the option trades. So I do, of course, I'm a trade in options. That's why we started this as a options for retail investors. But then we started discussing a lot of other stuff also. So I'm pretty active with trade options. But if we discuss all the trades, that's all. We'll need a few hours to go through trades. So every week I'll bring one trade, which we'll discuss here. So, okay, I have to have one more trade on Tesla. See, I created July trade already. So IBB. So IBB, what are positions? So we had created this trade, which was an iron condor trade. Put spread is 140, 130. Call spread is 160, 170. Stock was at 150. So this was like right in the middle, neutral trade. Stock is at 150. Went $10 low, sold a $10 white put spread. Went $10 up, sold a $10 white put spread. We opened it on 27th. Okay. Then the other trade we had opened was ARKK. It's a covered call. Our cost basis was less than 114. So we sold a covered call at 118. These were the two trades that were open when we reviewed. In our previous meeting, none of them were closed, but I added one more trade. So these two are still open, IBB, ARKK. But IBB stock started to challenge us. After I opened the trade, within 10 days, it was very near to our short strike of 160, call strike of 160. The stock was at 159.42. So gotta take some corrective measures. And the reason why it happened, Biogen. Biogen was up 40%. Their Alzheimer drug. Come on. Yep. 6-7. There we are. Biogen was up 40%. So Biogen is part of this IBB ETF that also pushed out. One of the reasons got pushed out was because of this Biogen. So try to defend it. We added another trade. I laddered onto another trade. We had sold earlier 2 contracts. Again, almost similar width. In this case, it is $9 white. So no, huge risk. So overall, it is still within my position sizing. Here, maximum risk was $2,000. Here, maximum risk is $1,800. So overall, if we lose everything on IBB, go back to IBB. What? Max, after include the premium that I've already taken, max loss is 3,200, 3,182, which is okay for my portfolio. I mean, you have to decide on your portfolio level. So if you are a subscriber, you get these trades in real time, and you should look at the contract based on what works out for your portfolio. In some cases, I might do 5 contracts. I generally don't as a part of my first trade, but in some cases it might if it is a lower values ticker, right? You need to decide what's right appropriate position size for you. So in any case, so as a part of trade management, added another trade, try to recenter it. Now it is actually already making some money. We got a lot of buffer around this current stock price. As long as it stays between 165 and 144, this should be profitable. Again, I'll wait. Maximum I can make in this is $1,000. So $1,000 risking 3,100. That's a decent risk reward. But I'll probably close it when I'm making close to $600 or $700. I'll close it then. So time decay has to come out. Still a lot of days available. So that's a new trade, IBB. This is a defensive trade want to talk about in today's meeting. So overall, till now we've discussed 45 trades here in this meeting. 3 are still open. 42 we have closed. 34 were closed profitably. Net proceeds just in this meeting. If you're just paying attention and focusing on these and you're following it up, at least on these trades, we have made close to $5,000 just on these ones, the one that we discussed in this meeting. Just taking care of some numbers, tracking some numbers. That's it for today from option trades and the IPO reviews. Didn't go through markets. So if you have any question on general market situation, for example, what happened to Lordstown Motors? Or why is Netflix now selling sweats? We can talk about that. If not, we're going to meet again on Tuesday. Bootcamp exit checklist. When do we close our option trades? Not whenever I want to. There's a science behind it. There's a methodology behind it. Like there was a methodology for trade opening that we discussed in session 6 or 5. There's a methodology behind trade closing that we will discuss in session 9 on Tuesday. And if you are in crypto, we'll talk again on crypto on 24th, on Thursday. So that's it from my side for today. Let me look at some of the comments, or if you have a questions, throw it or unmute and talk about it. Yeah. What was the Tesla trade options? Yes, that was options. To see, I mean, we all discuss option trades here. Ramesh said, I rushed to fin options too soon after Fed speech. JPM, Morgan Stanley, Bank of America. So, but I wouldn't blame you. The Fed speech was like that, which means financials should do good. Everyone was surprised. Even I was surprised. I mean, I already had position in Bank of America. I had position in XLF. XLF kind of worked out okay. I mean, the position is still on. Bank of America, I had a bullish position. I'm like, what happened? Why is financials down? Increase in interest rate is good for financials generally, but then markets do what they do. And later on, we can find any explanation. So I heard some analysts providing an explanation behind what is happening in the market, why financials are down. And their response was, if interest rates increases, customers will be spending a little less. And that means the banks, the economy will little bit slow down, and that's how the financial will get impacted. We can pick up any reason, whatever in afterwards. But financials going down and tech going high on the news of increase in interest rates, that was surprising for me. Yeah. Cool. All right. Any other questions? Any different topic you want me to cover for next Saturday? Because I don't think any other company is coming for IPO. I mean, there is one which is on a competitor to CrowdStrike. So let me take a kind of give me a +1 or on just give me number 1 or 2. Number 1, I like reviewing pre-IPO companies. Number 2, I want to focus more on the general market. What happened in the last week? Give me your choices. Do you like number 1 or number 2, so that I know where to put the content, where to focus on. Essentially, the idea is needs to be useful for all. And Jay says 1.5 both. Yeah, if there was only one company, I could have covered both. But today I had a 2 S1, so I covered mostly S1s. Okay, I see 2 more. Okay, so it looks like more interest on, there is decent interest on pre-IPO companies. So I will try to do that as a market. IPOs are rare. I think it's been a little longer gap than I would want it to be since I have reviewed a pre-IPO company. Of course, there's a lot more time that need to be spent for me to go through S1s and all that. And that was one reason why I didn't review some of the companies earlier. So, but here we're back. We reviewed 2. To compensate for the gap, today I reviewed 2. Sorry if it is an overload reviewing 2 companies today. Cool. So that's it from my side. If nothing else, let's call it a day. And I'll talk to some of you on Tuesday or on Thursday. Have a wonderful weekend.